Welcome on in. You're watching Lowcountry Money Talk. It's good to be back in studio with you.
Oh yeah, I'm glad you're back.
Oh, me too.
Okay.
You know what? I've missed a few things, but I've been paying attention. I've been watching, following your lead.
Sure.
Lots going on as usual. Still a lot of market volatility, of course.
Always.
The good news, though, folks, is that we can learn something here.
Sure.
I think there's a lesson in challenge. So what is it that we should be learning?
Well, the first thing, we don't want to be paralyzed by what's going on, so we don't want to be like a deer in the headlights. We need to take problems and make opportunities. So we do have a lot of volatility based upon what the federal chairman, the chairman to the Federal Reserve said this week. This is going to continue, and he was saying a couple years. That doesn't mean the stock market's going to be bouncing all over the place for a couple years, but he said this week that he didn't expect inflation to get under wraps until 2025.
Wow, that seems like it's so much further out than I was expecting.
Not a quick fix.
It's not a quick fix. Okay, so inflation is, I guess not going to really get under control, meaning the Federal Reserve is likely going to continue to increase interest rates in an effort to really kind of slow that economy down.
Sure.
So what does that mean for retirees? What should they be thinking about? How is this going to impact them?
Okay, with the inflation. So if everything costs more and I'm on a fixed income or I'm taking a certain amount out of my investments each month, I'm going to have to take more out, right? So then the problem is, if I have too much invested in the stock market, which is heading down more, I'm going to take more out of something that's heading down south. So probably don't want to do that. So I think what we do is say, first of all, do I have the right amount of my retirement savings at risk in the stock market, or do I have too much?
Yeah.
That's number one.
Okay.
So if I have too much, I really need to adjust that, because I believe the market's not done going down.
Yeah.
Because if we look at historical bear markets, typically that S&P 500 index will go down around 35%, and we're at 20 now. So
we got a ways to go if history tells us anything.
Well, so the point being is, I need to get that percentage or that ratio corrected first, okay? The next thing I need to do is I need to get some return on my investment that's not going down in the stock market, so that's one thing. But first of all, we need the percentage right. So if I'm 70, maybe I should really only have 30% in risk assets. The second thing we might want to do is, how can we lower our taxes? Most people are paying too much in taxes. I think the viewers would agree. So let's take a look at how we're doing the withdrawals from our assets to buy things that we need or for our monthly income. And if we can lower the taxes on our withdrawals, then maybe that will satisfy some of these inflations. The other thing that we can look at is lower our expenses of our assets. So if we're paying too much in expenses for the management of our 30% or our overall portfolio, if we could lower that, then maybe we can make up for some of that inflation. Because remember, Jessa, inflation is 8.3 year over year from August. But the problem is, what was the inflation last August?
Right.
It was over 5%.
So it's just compounding each year.
Yeah,
Yikes.
so really, we're paying well over 13% more. And then if you look at the prices of food and stuff, it's way over that,
Right.
And I think if we look at our last CPI number, it was with the oil prices down and the gas, well, that's going to change and they're going to go back up because we have this 1 million barrels a day coming on the market through our strategic reserve that ends in October.
Okay, well, the good news is for your clients, Phil, I know that you really look ahead and make sure you're adjusting for these different factors, for inflation, for interest rates changing, tax change, all these different things, so that you're not just holding on for dear life and hoping for the best.
Right.
You've got a plan. So we're going to talk more about that and a little bit about what you should be making sure you're taking a look at for our viewers out there who are in or nearing retirement. And the good news is we have expert Bloyd from Revolutionary Financial Group.
Absolutely.
Going to be back after the break. Stick with us.